Good afternoon and welcome. My name is Bill Woodruff. Today I'll be hosting the WealthFactor review of global financial markets and investing through the end of September of 2020. Before I get too far in, let me please share a few words for compliance purposes. This call is for informational purposes only and may be recorded. Statements made during this call are subject to the opinions of the speaker, and the risks and uncertainties of which are significant in scope and may be in their very nature beyond the control of WealthFactor. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. For those of you who don't know me as well or at all, I am the founder and operate as the Chief Investment Officer of WealthFactor. I've been involved in investing for over 20 years now and have a diverse professional experience set spanning early stage investment advice and investment management businesses, and also as a managing director at a publicly traded asset manager. WealthFactor is a Lake Oswego-based investment advisor. WealthFactor provides customized investment plan and financial planning-oriented investment advice. All of the portfolios managed by WealthFactor are custom and typically based on indices comprised of stocks and/or bonds. Accounts of WealthFactor clients are held in their name at independent third-party custodians. WealthFactor's fee model is unique and a big part of what makes WealthFactor different. We charge a 0.35% asset-based fee, which is likely less than a third of what you'll see from a similar service set. WealthFactor is in its services centered around an investment philosophy called RiskSmart. RiskSmart has three different component parts. The first is about being what we call portfolio smart. And this is more oftentimes about what's avoided in how you receive investment services or investment advice or investment management, and less about what you are trying to get or find. And this oftentimes can be, as many things are in investing, counterintuitive. It's my belief to be portfolio smart. Investors should be avoiding things like picking individual stocks or trying to time the market. They should be avoiding layers of management and unnecessary complexity. And I would say most of the time, if not all the time, complexity is something that should be and easily can be avoided. The second component part is being fee smart. And we, in offering our service and focusing on systems, automations, and efficiency, eat our own cooking on this one by charging our clients only 0.35%. But we take it a step further, and this is interconnected to being portfolio smart. We're working tirelessly to identify efficiencies and remove layers. And layers always include increases in total costs. And the last component part is being tax smart. In my time in the industry and spent with other investment professionals, tax is almost always an afterthought. It's my belief, though, that tax is likely the single greatest area through intelligent design and perhaps even to some degree active management that an investment manager or an investment advisor can add value on a specific or individual customer or client basis. RiskSmart Investing is in its essence based on the belief that high fees force risk in portfolios. This serves no purpose for anyone other than the margins of the investment manager or the investment advisor. On our overview today, I'm going to cover a handful of items here, including valuations, looking at that, and then also spending a little bit of time on the relative risks across asset class and risk type. As I think about managing portfolios risk efficiency relative to each specific investor's circumstance and ability and willingness to tolerate risk really should be the focus of any investment advice service provider, not an attempt to predict something that cannot be predicted. Taking a quick look at valuations, and per usual, I'm not going to spend really any time talking about what did well and didn't do well yesterday. I just don't think or believe that's useful in how one should position their portfolio going forward. I'm going to jump right into some of these topics and some of the prepared content here. This graph is the S&P 500. It comprised in a particular way to highlight inflection points, specifically from a valuation perspective, and it's using forward PE for the S&P 500, and in each low and high point, it's isolating what are effectively extremes for valuation. And so we can see today, for probably lots of very logical reasons, at a forward PE of 21.5 on the S&P 500, that's at a relative high point versus historical. And if you were able to catch my prior month's review, I spent a little bit of time on this concept, but really more from a non-US perspective. And in that graph, shared some thoughts relative to Japan as a comparative, both from an interest rate perspective as well as a valuations perspective. The point that came out of that analysis was, while we might be at the upper band of our experience set in U.S. equity valuations, we're nowhere near the levels that Japan has seen in its history. So back to focusing on the U.S., which I think as a US-based investor is logical. This takes the S&P 500 index forward PE ratio and looks at it relative to its 25-year average to give us a more specific sense of how far above average historical experience are we. And just over one standard deviation is material, but in my experience as operating in global financial markets, oftentimes they operate well outside of normal distributions. No doubt valuations are high relative to historical averages. The unanswerable question is, does that matter, or does that mean anything, and should we take action? And that could be perhaps a full conversation and dialogue. But my general thinking is probably not. Should it influence perhaps our asset allocation in certain circumstances as investors approach retirement and become in retirement? Potentially, but I think for that needs to be looked at on an individual circumstance basis and through thoughtful analysis, pairing the right mix of assets and the right investment approach or structure or investment plan per each circumstance. The next page here looks at what this is trying to get at. Is there a predictive relationship between valuation and future return? The graph on the left is looking at a very large data set or number of forward PEs and looking out over the next 1 year and saying, what was the return over those next 12 months? And then the next one, the right side is doing that same thing, but looking out over the following 5 years. And the downward slope to the regression line suggests that there is some relationship between valuations being high and returns being lower. However, we can see, especially over a 1 year period of time, that predictive relationship is weak at best. And there are significant occurrences where even though valuations might be high or above a certain level, the following 1 year and in many cases 5-year performance for equity markets is positive, in some cases very meaningfully positive. Valuations matter, but in terms of their predictive value, especially in 1 year or the short run, there's a very limited predictive value there. Throwing this one in here, it's a little bit outside of how I think about, or I guess I don't know that there's a whole lot of importance in this information, but it's clearly very timely as the November presidential elections, and I guess are coming up soon. So in this analysis, it's going back a long, long way. What it does is breaks down the performance of the S&P 500 by calendar year, and then the color as well as the real GDP And then the color of each bar on the chart is representing the government control, with gray being a divided government, blue being Democratic-controlled government, and red being Republican-controlled government. And it's, are there conclusions here? You can loosely see that the average returns for Republican-controlled government are higher for the S&P 500. And as you think about what drives equity prices, it's really the future. Think people or all participants in the marketplace in aggregate attempting to predict or assess what future earnings, dividends, et cetera, might be worth. And so if you look at Republican policy, you would say, okay, well, Republican policy is going to be generally more supportive of bigger business, or perhaps even business in general. And so there's going to be naturally more optimism. Well, there's a counterpoint in the data here as we look at the real GDP change for Republicans. So while the S&P might really like Republican governance, real GDP hasn't necessarily had that same effect from that Republican governance relative to the divided government as well as the Democratic one. And the practical reality here, while this exercise might be timely, I don't know that there's a whole lot of meaning in this analysis, in that there's a lot of different underlying randomnesses that drive all of these elements: GDP, long-term demographic headwinds and tailwinds, all sorts of elements. And my advice on the topic of positioning portfolios before and after elections is to completely ignore it. There will be likely some increased volatility leading up to it, and maybe some significant volatility shortly after the outcome of the election is known. But beyond that, there are much larger factors that will drive the performance for equity markets over time. Shifting gears to fixed income dynamics, fixed income is likely an area that poses the largest challenge to all types of investors. I think if you're out beyond 10 or 15 years before you're going to use the invested funds, the case for fixed income, in my opinion, is very weak. As you approach retirement or are in retirement, the case is still weak. Low yields have limited potential benefit to an investor looking to generate income from their portfolio. Does that mean that fixed income shouldn't be used at all? I don't believe that. I think that in my experience, the financial markets, including interest rates and credit markets, will live outside of normal distributions for far longer than we think that they should. And that could put you in an example of that might be perpetual deflation, maybe not unlike what we saw in Japan for a very long period of time. And in those sorts of scenarios, owning fixed income today, it may end up being a very good thing. There's a couple different points I'd draw from what is a lot of data on this particular page. But on the left side, just to clear it, the information, the top part of the left side shows yields as of the end of September for U.S. Treasuries. So let's all assume, for the sake of relative comparatives, that there's no credit risk in U.S. Treasuries. And so we can see yields at incredibly low levels, 13 basis points on the 2-year, or very close to zero there, and only 0.69% for the 10-year Treasury. So you're not getting a significant amount of additional compensation, at least in dollar yield terms. Perhaps on a percent difference basis you are, as you go out and take what is really a significant amount of interest rate risk down at the 10+ years of maturity on the curve. We can see that there's been some change, but very little change over the entire quarter from a yield perspective as we look at it relative to June 30th. In terms of return, so we see big numbers here really across the board, and that's reflective of the dynamics of fixed income. If markets yields decline, fixed income or bond prices appreciate. And so as these yields have dropped dramatically this year, we've seen that corresponding benefit from a bond portfolio through appreciation. In my experience working with both investment professionals and investors directly, have seen oftentimes investors look at prior performance for fixed income funds or fixed income in general. This is such an extreme case as to why that makes little to no sense. So as yields approach zero, it's, theoretically they absolutely can go negative, but there becomes a significant asymmetric potential for appreciation in fixed income portfolios versus depreciation because of how low yields are. And so interest rate risk is a critically important risk to understand and get right in all portfolios today. The bottom left section is looking at what the investment management world would call mostly spread, and I focus on this in its simplest forms in terms of the corporate credit market, and then I break that out between investment grade corporates, which is the first line under that sector, and then high yield, which would represent non-investment grade fixed income. And so as I think about this, so the first step is, am I getting compensated, or are the risks worth it for U.S. Treasury fixed income? And so if the answer to that is yes, then to me, that is where investors who are looking to counteract risk outside in other areas of their portfolio, equity per se, should be focused. If the answer to that is no or not really, then the next question is to say, okay, is the compensation for taking additional credit risk worth it? And so as we look at investment grade corporates, the yield on those has widened dramatically in the initial outcomes or how the coronavirus period of time played out, and have narrowed dramatically since then and continued to narrow through the third quarter of the year. And now in a portfolio of investment grade corporates, and it varies based on maturity, but in this very diverse index being used here, there's a 2% yield there. So you're enduring the interest rate risk that you would normally endure with treasuries, plus you're enduring a credit risk in a basket of U.S. companies as borrowers. And very quickly it's getting harder and harder to say, okay, I'm getting compensated for those risks. As we go down to high yield spreads ballooned out far wider, and they've come back in really, really quickly, just like equity markets have recovered. And so we saw, over the course of the quarter, yields decreased from 6.87 down to 5.77. And as I look at that and say, man, the lower that number gets, the less I'm being compensated for what is a very material amount of risk. And so should investors invest in high yield? My general recommendation is right now only if the need for income is so high, and as always, or at least the vast majority of the time, I think about investing in high yield or anything that's non-investment grade out of the equity risk bucket of an overall portfolio. So really, my recommendation for most clients who aren't very much dependent on deriving income out of their portfolio is they look to equity markets, because of the equity markets have so high yield or bonds in general lack the appreciation potential and the inflation protection potential of equity markets. So if I'm going to take equity market risk, I'd rather take equity market risk. The yield isn't a priority over high yield when high yield yields and spreads are low on a relative basis. On the right side, it puts some of these spread concepts into historical perspective. And so there's a range and I look at this as maybe a little bit unnecessary in the amount of detail. So the dotted line in the middle of the graph on the right is separating investment grade and high yield. And on both sides, it's breaking that down even further into the highest rated of investment grade down to the lowest rated, and the same thing on high yield. And so we're seeing a bit more granular detail, but the conclusions are really the same across both sides. The purplish bar or line in that range is where it is currently. And so we can see that those relative to historic ranges where spreads are at a low level, and then the blue diamond is an interesting relative data point because it was the year-to-date peak. How bad did it get at the tail end of March when risk was selling off across the board? And we can see that it was bad, but we've seen a lot worse, which I think is fairly interesting. I think just like as you think about equity valuations, the low yields have distortive effects on asset prices. And I think that probably translates to corporate credit spreads as well. A 465 additional basis points of yield in a BBB rated corporate bond on an incremental additional dollars of yield basis is really material. If you rewind to when market yields across the board were dramatically higher, 400 basis points might have only been double of what you were getting before, not 3 or 4 times like it is today with our record low levels of yield. I'll conclude today with just a quick reminder about the importance of having an investment plan and implementing it in a disciplined way. This is a bar chart with data based on a study conducted annually by a company called Dalbar. And what it's doing is looking at the performance over 20 years and annualizing it, and then for a variety of asset classes. Key part here is the orange bar. What is the average investor's experience? And the biggest takeaway here is that average experience for the average investor dramatically underperforms the majority of asset classes. And it's my belief that can largely be attributed to a lack of having an investment plan, but also the natural human tendencies we all have from an investor emotion and bias perspective. There is constantly reasons not to be invested in equities. And to be successful in equity investment, I believe you have to, or really investing in general, is ignore those human emotions and bias, as well as that short-term noise that is persistent and perhaps getting magnified thanks to access to information via social media. And having a plan and likely having a disciplined steward to assist in executing on that plan is of critical importance. I hope you found these comments useful. I would welcome the opportunity to take any questions you might have, and please find my contact information here.